Well, David Miller, thank you so much for coming in today. How do you rate the situation in Europe? I guess very risky, but how do you play on that in a portfolio? How much cash do you have? How much of these bonds and gilts do you own? Of course, because they're just safer.
Yeah, well, you've got to get away from the day-to-day problems that we're facing in Greece, and it's impossible to guess the next bit of news. So what you have to do is focus on how to deploy capital. We've got investor capital to deploy, and there are two things to look at. One is safe haven fixed interest investment. Gilt market looks pretty good on that basis. And the other one is equities, where you've got good value, and it's been good value for some time.
David, that means that you actually take a longer-term view. I mean, I guess it's very difficult for an investor to extract themselves from the, oh no, is Greek defaulting? Are we going to see more troubles in Europe? So your number one advice would be what? First of all, to look at a one-year period of investment, a 6-month, or it has to be really 2-3 years? It
doesn't have to be as long as that, because the volatility is just so high at the moment that you're getting opportunities almost on a daily basis. So let's look at the gilt market. It's the hardest thing in the world to buy something that's already expensive, and that's where we were with gilts earlier this year. But it's a decision we made because we felt it was a definite negative correlation to risk elsewhere. It's an under-owned asset amongst active managers. The people who have been buying it, the institutions who have been buying it, are not price sensitive. So it's either the MPC or the banks looking to bolster their capital, or the pension funds looking at multi-decade liabilities. The active managers have been short duration and long credit risk, and they've missed it.
But just like German bonds, it's an overcrowded market.
Well, it isn't. In some ways it is, in some ways it isn't. It's clearly a risky investment to make, because at some stage bad value will become apparent to all of us. But in the UK gilt market is just that much further away from the precipice than other parts of Europe, and that's attracting investors.
What do you make of what the ECB said last week? Because this was the first indication of what the ECB is going to look like under Mario Draghi, and I guess that also, of course, gives you an indication of what bonds seem a good buy compared to gilts.
Yeah, well, it's fine. I mean, he's new to the job. He made a good start by cutting rates a little bit. He needs to cut them further, and I think the next stage for Europe will be quantitative easing. They've got to recognise that there's a recession coming in Europe, and they need to do something about it. The rest of the world is now looking at Europe and saying, we can get on without you. That's why the numbers in other parts of the world are starting to attract investors. They're starting to look a lot better.
What about equity markets in general? Are we going to see a large correction? Again, correction, and how do you play that up? Do you stock pick some of the defensive stocks which have good management and dish out dividends?
Companies are making great decisions. They've been working on the fact that it's going to be tough for 3 or 4 years now. They've built their reserves up. They've got strong balance sheets. They're generating cash. They're not taking on extra expenses. So what happens at the moment is that the macro news day to day is driving the market up and down. Correlations are high. It's very difficult to say, I know the right stock to buy. But what you can do is look for companies that have got the right characteristics. And if, as we found in early August, in early October, the markets are down 15–20%, you can buy into these companies.
But so what are the right characteristics? I know, for example, you like packaging company DS Smith. Is it the exposure to, we'll always need packaging, basically, and exposure to emerging markets? Or, again, is it just like small defensive companies that have their cost-cutting under control?
What they've done is great. I mean, capacity's come out of that sector over the years because it's so unfashionable. And Cheviot Smith has found itself as being the major provider. It has pricing power. So to answer your question, the first thing is, can you pass on the price rises? So input prices, energy and the like, are higher, 10%, but they're actually sustaining 15% price rises. That's generating good profit flow, and dividends will go up on the basis of that. That seems to me to be the right model. Now, if this share goes down 20%, which it did in August, for no reason at all other than problems in Europe, you go and buy it.
All right, thank you so much for your time. Interesting analysis. David Miller there, partner and investment manager at Cheviot Asset Management.